Nouriel, great to have you back on the program. Let's first talk about the U.S. economy, because this week everyone is a little bit fearful about how these numbers have come in. How fragile is the U.S. economy in your mind?
Well, the employment report today was a mixed bag. Unemployment rate went down. That's a positive. Job creation was okay, while wage growth is going down. So it's a mixed bag, but overall good. But I think the most important point is that the labor market is a lagging indicator of economic activity. Production is a coincident indicator, while CAPEX, ISM, and PMIs are a leading indicator. So what's happening in the U.S. economy is that we're having a manufacturing recession, as the ISM and the PMIs in industry and manufacturing show. The data on services show that also leading indicator of the service sector show a slowdown of the economy. So it starts with CAPEX that is down, then goes to the forward-looking indicator, then it spills over into production that is okay but slowing down. And employment is lagging indicator, so it's going to take 2 or 3 months until we see a further slowdown in job growth. So while the number today on the labor market was okay, it doesn't signal much because it's looking backward, while CAPEX, PMIs are looking forward, and they're showing we're already in a manufacturing recession, and it's spilling over also into the service sector. So we are in a situation of subpar economic growth, where growth could stall, especially if some of those tail risks materialize.
Nouriel, in your report that you wrote about the 4 collision courses, a lot of this focuses on geopolitics, but as it pertains to the trade situation and the tariff battle that's happening between the U.S. and China, is it possible to figure out right now in this slowness we're experiencing what is trade policy induced and what was a natural cyclical slowdown? Because we did see some of these global PMIs start to roll over before trade really escalated last year.
It's a combination. The fiscal stimulus is fizzling out. The fiscal impulse is going to be close to zero later this year into next year. But I think that the trade uncertainty, the risk of a trade, currency, technology, and Cold War between the US and China is already affected global business confidence. That's why CAPEX is down in US, in Europe, in Japan, in China, in emerging markets. There is an option value waiting. Why would you want to build a new factory if you don't know whether it's going to be 20, 30, 40% tariff on Chinese goods exported to the United States? So manufacturing is already globally in a recession, given the option value of waiting. CAPEX is down, manufacturing is down, exports are down. What's sustaining global growth is domestic demand and consumption and services. But suppose that by mid-December we were to impose the tariff also on the remaining Chinese goods. Those are the kind of consumer goods that are bought by the white blue collar in Walmart. The price of those goods is going to go up. It's going to reduce disposable income growth. That's going to stall consumption growth, because the only component of aggregate demand in the U.S. is going up is now consumption. CAPEX is down, residential is soft, government spending is flat, and net exports are weak. So the risk is that this trade war is going to imply a stall of growth and a recession if there is an escalation of the trade war between US and China. So definitely this uncertainty is already affecting business. It may also affect consumption in the next few months if we raise the tariff on consumer goods in December.
Nouriel, we spoke about a year ago, and one of the questions that we talked about was whether or not the activity in the U.S. that was happening in early 2018 on the back of tax cuts and that strong consumer, if it would be enough to basically propel the U.S. across a sort of valley of growth as the rest of the world was starting to slow. A year later, we're still kind of the best house on the block. Is it possible that this global mini recession or possible beginning of a real recession that we've had the last 18 months around the world, but not here in the U.S., is the domestic ability to kind of get us across that bridge? Is it possible that what we're seeing here is the bottom for the U.S.?
Well, the growth last year above 3% was artificial, was driven by a $1.5 trillion tax cut and $500 billion of additional spending over a decade. That stimulus is phasing out. That's why the economy is going back to potential, and Fed and CBO estimate that potential is the best 1.8 to 2%. But growth is going to go below potential because we're starting a trade and currency and technological war with China, and the rest of the world is weakening, and the US cannot shelter itself from what's happening in the rest of the world. But this is a self-inflicted growth stall. It's not driven by global shock. It's driven by an economic policy protectionism, America first, buy America, hire America, make America great again, that has led to restriction to trades in goods, in services, in capital, in labor, in technology, in data and information. This is the beginning of deglobalization, of balkanization of the global economy, of decoupling between US and China, of fragmentation of the global economy. This is a massive negative supply shock. It's going to reduce actual growth, potential growth, and increase inflation over time in US and globally. This is a major supply shock, and that's what's driving growth down. And the fiscal stimulus is now essentially becoming neutral, is fizzing out. If anything, we'll have a slight fiscal drag into next year.
The first on your list of the 4 collision courses you see and the game of chicken that you described that's happening between the U.S. and China, given that we did just see an unemployment that's still as low since 1969, what's the time frame you see that somebody has to pull over their car before the crash happens, Nouriel? Do we have a little time to let this spat go on, given the strength of the employment, or is the collision course you see soon between the U.S. and China?
Well, as I pointed out, the labor market is a lagging indicator of economic activity. The leading indicators are capital spending that's been done for months now, ISM, PMIs in industry already negative territory, and a sharp slowdown also in services. So with a lag of a few months, that leading indicator is going to spill over into the lagging indicator, and I expect that the labor market is going to soften up for sure if the ISM and CAPEX go in this direction. Therefore, we are going towards a slowdown. The question mark is whether this trade war with China escalates or not. There are 3 scenarios. A full deal, I don't think that's possible. The 2 sides are totally far apart. A full trade and technology war. Both sides, for political reasons, may want to avoid it. But even if you're going to have by year-end a truce, the U.S. is going to go ahead and increase to 30% the tariffs on the first $250 billion, and is going to increase to 15% at least the tariff on the consumer goods by mid-December, even in this situation of a potential truce between U.S. and China. Therefore, the negative impact on consumption through an increase in import prices on consumer goods is going to materialize, and therefore I see further economic slowdown ahead. Even a truce is going to be negative for economic growth and weaken the economy much more compared to what it is right now.
Nouriel, when you look at what else is happening around the world, this morning reports from Bloomberg, I want to talk Brexit here for a sec, that possibly Boris Johnson might be softening up on the October 19th deadline. The ramifications of a hard Brexit, second on your list here, is it really going to be people starving in streets and not being able to work and not being able to find basic goods? I mean, some of the narrative we've heard on this has been so apocalyptic that how does it even live up to expectations if it does go south?
Well, it's not going to be that apocalyptic, but a hard Brexit is going to tilt the UK economy slowing down into recession. And even the European economy is going to stall, because right now we have a near recession in Germany and Italy. Germany, Belgium, Netherlands, Ireland export a lot to the United Kingdom. Business confidence is sharply down. The PMIs in Europe are much worse for manufacturing than they are in the United States. And the kind of a confidence shock of seeing thousands of cars and trucks stuck at Dover and Calais because of the paperwork required after hard Brexit is going to have a huge negative impact on business confidence. It's going to weaken business confidence, going to weaken the economy, and CAPEX is going to lead to a correction in European equities, at least 10%, and it's going to spill over as a risk-off to the global economy, and consumer confidence may go down. So you might have animal spirits of consumer, businesses, and investors essentially tilting a European economy that is borderline into a stall, into an outright recession. So it's not just the UK, but it's going to be the rest of the European economy and the Eurozone that go into recession. So you don't have to be apocalyptic. Just a negative impact on confidence can essentially turn this manufacturing recession in Europe and the UK into an outright recession, and we're weaker in Europe by all standards than we are in the United States.
You mentioned the slowness in Germany, obviously a very export-heavy country, another area of the world that's very exposed to autos and secular trends. Do those necessarily reflect a core economic slowness, Nouriel? Is the Germany situation as bad as it seems from the export side? Because some of the employment data lately has been somewhat encouraging.
Well, like in the US and the rest of the world, in Germany, industry is down, capex is down, exports are down, domestic demand is strong, consumption is strong because you have low unemployment rate and okay job growth. But Germany has an 8% of GDP trade surplus. The currency war between US and China and the trade war and that war is hurting their exports. The softness of growth in China emerging markets is weakening Germany. The weakness of Italy and the rest of the Eurozone is weakening Germany. And the recession coming into the UK, and if you had hard Brexit, it's going to have a shock to the exports of Germany to the United Kingdom, is another shock. And there is also the risk that the US at the end of the year is going to impose tariff on European auto exports to the United States, and those are mostly German exports, and the German auto industry has already had a stall because of the switch from diesel to other types of fuel, and so on and so on. So Germany, that's supposed to be the strongest economy in the Eurozone right now, together with Italy, looks like the weakest, because its openness to trade implies that when there are all these global tail risks, is the first victim of those global headwinds.
Nouriel, the other two that you mentioned here are about what's happening in Argentina, and then also the risk of possible escalation between the U.S. and Iran. I want to talk about Iran for a sec, because in your report, what you talk about is the risk to higher oil prices. But when I look at the last 20 days, we had a shock attack on Saudi oil fields that had the potential to, it looked like, spike oil to the moon. And this trade couldn't even last a week. Oil dropped right back down. So where's the risk to oil in the upside if that kind of shock wasn't even sustainable?
Well, first of all, oil prices had fallen before this attack because there is a risk of a global recession because of US-China, and therefore in that recession, demand for commodity and oil is going to fall. The shock led to initially overnight to a spike in oil prices by 20%, then by 5%, and what happened was that the damage to the oil facilities was less than expected and is recovering, and therefore oil prices are still up but less than before. The global weakness is a softness for oil prices, but the attack shows that if you can be so low tech, send a bunch of drones with bombs, and for even a period of time damage the production capacity of Saudi Arabia, a bigger attack with rockets could destroy it, or the Iranians could block the Strait of Hormuz in a situation of a hot war between US and China. I think that while that hot war is unlikely, we have seen 3 episodes in the last 40 years of a geopolitical shock leading to stagflation, recession, inflation. 1973, Yom Kippur between Israel and Arab states. 1979, Iranian Revolution. 1990, Iraq invasion of Kuwait. In all of these cases, there was a shock to oil prices, an embargo, oil prices spiked, inflation, recession. So conditional on a hot war between US and Iran occurring, oil could go very easily above $100 per barrel. Gasoline could be $4 or $5 a gallon, and then that kills the US consumer and tips the US economy into recession. Yes, we produce a lot of shale gas and oil, but that benefits the producer. The distributional effects of an oil price shock is that profit may go higher. That doesn't increase economic activity, while the consumers are hit and they're going to cut consumption. So if that hot war between US and Iran were to occur, and that's an if, then that will be another tipping point for the global economy. So I think people are underestimating, because an accident can occur. The two sides are on a collision course and they're provoking each other. Now, Trump knows that if he attacks Iran, they're going to counterattack and oil prices are going to spike, so he has restrained himself. But the Iranians are keep on provoking the United States, first with the drone down, then with the attack on the oil facilities. When the US is going to attack, following a provocation, an escalation can occur, and the price increase is not going to be for a few days, it's going to be sustained over time, especially if the Strait of Hormuz were to be blocked by the Iranians. That's certainly a tail risk to keep in mind.